Hello, folks. Welcome back. So today is September 22nd, 2025, and this is the focus on Forex. We're looking at the US dollar, fiber or EURUSD, and pound dollar or cable. Right, this is the dollar index. The daily chart's on the left-hand side. As I mentioned last week, we traded up into this volume imbalance here, and we traded one more time into that, just breached the outside high end of it with the wick of daily range. And I mentioned that there would be a likelihood of this down close candle and this up close candle becoming a inversion fair value gap. So we saw some sensitivity here last Friday, and it may need to come back down and retest that and trade into it. Now, since it's already responded on the upper quadrant of this SIBI, which we've looked at and anticipated as an inversion fair value gap that's bullish, the midpoint of this SIBI here, that red line here, price needs to only be in the upper half. Now, it can touch the midpoint. It's better that it doesn't. And if it starts to resume going higher and attack these relative equal highs after it trades into the inversion fair value gap on the daily chart, that might be the fuel that's required for it to trade up into, say, this liquidity pool that's next on the daily chart. Overall, we're still inside of a large range, but I'm looking for signs that we've put an intermediate term low in. And that's kind of like where we're at. A lot of wartime stuff on the news front. So it's going to be very knee-jerk reactionary type responses in dollar index going forward into the end of the year. So breaking it down on the 5-minute chart, you can see we worked up into that daily volume imbalance. This red area here is this area on the daily chart to the left. So you can see that little tiny little spike above on the daily chart. That's this here. And crossing over the midnight into today's trading on the 22nd of September, the market breaks down, creates a small little bearish fair value gap, rate and consequent encroachment of that daily volume imbalance. Note that. I don't have the line on there because it would be too much in one single little area. And I want to kind of like summarize every market I cover on one screenshot like this. It allows me to get through it quickly and straight to the point. So I counsel you to put a mid-level line on that rectangle on your daily chart with this volume imbalance between the two candlestick bodies there. And you can see that it's respected that consequent encroachment with that bearish fair value gap. Market breaks down, another fair value gap there. And notice it doesn't get up into the volume imbalance when it trades up into these two candlestick wicks. So that bearish fair value gap here, it sends price lower, attacking the sell side in here, deeper than it did the first time. There's a small little shallow probe of it here. Hey. Then market breaks lower, goes into another fair value gap there as well. And I'm looking at this across these two candlesticks here because this was actually shown as a single fair value gap on the 10-minute chart. So looking at that right there, I'm blending that. So anytime you ever see me annotate a chart, if I share a chart on Twitter or what we call X now, it may look like I'm drawing the fair value gap incorrectly, but I'm looking at it at a higher time frame. So for instance, this is showing a 5-minute chart. Viewing this over the lens of a 10-minute chart, this would be a single sell-side imbalance, buy-side inefficiency. So that fair value gap there is a 10-minute. And it's just a matter of going through all the time frames. And I go through a myriad of different time frames. I don't just go to the static ones that everybody goes to. If there's a cluster or a consolidation of price action, I'll go down to every single 1-minute interval. So what I mean by that is 1 minute, 2 minute, 3 minute, 4 minute, 5, 6, 7, 8, 9, 10, 11, 12, and look for refinement in that inefficiency. And it's something that you should be doing. Now, when price is stretched out, like for instance, in this portion of the price run, you wouldn't need to do something like that because you can see it on 1 or 2 and it's obvious where the imbalance is. So the market reacts here. Look at the bodies respecting the consequent encroachment of this 10-minute, but remember, we're on a 5-minute chart. And I know something like this I'm saying is going to be confusing to some of you, but I promise if you toggle your chart to 10-minute, you'll see what I'm referring to. But the midpoint or consequent encroachment is being respected by the bodies here. We break lower, we have a volume imbalance. Market creates a consolidation here. It spikes up into that volume imbalance, lays a candlestick wick right in there perfectly, and then sells off, gravitating back towards this potential inversion fair value gap that might maybe lend to higher prices to take this out. Or if it fails, this is the point here. If it fails and trades through the midpoint here and gets down into the lower quadrant, the likelihood of bullishness evaporates considerably, meaning that we may have to revisit that low and go a little bit lower. So this is the catalyst or the line in the sand that determines for me what the next leg in price action. Right now, I'm going to stick with the likelihood of this potentially presenting itself as a bullish inversion fair value gap. Truth be told, I have no skin in the race on this, so I don't care if I'm right or wrong because I'm not trading Forex, but lending my analysis and my opinion and counseling you not to use it as trade advice. Just observe it and study it and just kind of like peek over my shoulder and keep tabs on what you think versus what I think is going to happen. Maybe the market trades lower during the London kill zone at 5 a.m. Then we have a little consolidation. It rolls over a little bit lower, and we pick it back up at 7 o'clock in the morning, which is the New York kill zone. Trades into a bearish fair value gap there. Trades lower, right back into it once more to attack the relative equal lows where there's sell side there. Then we have a New York session reversal, trading back up and leaving these relative equal highs here. Breaks lower, small little inefficiency in there. I didn't draw. And then we went lower once more. And it looks like it wants to dig into this daily potential bullish inversion fair value gap. And again, that's this area here, which I stated would likely be an interest of mine should we go higher when we were trading on that day. And then we went through it. So the next day on Friday, we opened, traded down into the upper quadrant, which is this line here, and then sent us up into the daily volume imbalance. And once we got there, we're pulling back down lower in the attempt maybe to see this act as a discount ready to send it one more time higher. All right, the euro dollar daily chart on the left. I mentioned this inefficiency in the last passing of my commentary on euro. And the bodies have perfectly respected that inefficiency while allowing the wicks to do the damage. So notice how we saw today trade below Friday's low. We traded into that. I'm going to counsel you to add the gradient levels on this discount wick, and you'll see something in here that I'm not showing you here, not because I want to hide it from you, but I like to leave little things in here for you to find on your own. And the bodies respect that bullish fair value gap, and it rallies back up into this inefficiency that's shaded in yellow. This is a buy side balance, sell side inefficiency, but now we went below it. So trading up to the midpoint, it would be bullish and continuous bullish if it goes above it and then trades as an inversion inversion fair gap. It reclaimed bullish fair value gap in this yellow area. On the London kill zone, we see a breakaway gap here. Never trades back down into it. Immediate rebalance here that I don't want to annotate there because it's getting busy with a lot of annotations. You can add that to your own. Bullish fair value gap there. And we have the market trade back down into another bullish fair value gap as well. And that's actually an order block too, but I didn't want to add it because it's too many annotations. You can add it for yours. That's what I'm counseling you to do. Then we have this low, this high, and that lower low. So that's a bullish breaker. And we have the order block, which is the 2 consecutive down close candles. And that's a change in the state of delivery. Bullish. So we hit that. And also we're hitting the low of that volume imbalance over, I'm sorry, not volume imbalance, the fair value gap on the daily chart. We're seeing it hit here. So this green box area here during the kill zone is basically touching right there on the daily chart. And then we see the extrapolation to the upside, a institutional order flow entry drill here, a fair value gap that doesn't get filled just by one tick. It trades below the high of it. And then the consolidation here rips through it, trades up into the lower quadrant level at 1.17829. And that's this level here, the lower quadrant of this old bullish fair value gap. And we had multiple attempts in here to kill zone during the New York Open. And we break lower to clear up the sell side here. And then it springs higher after creating a fair value gap and trading into a propulsion block. This is the order block here, but then this candle is higher, trades down to halfway, but doesn't close below the halfway. And that's a definition for propulsion block. If you want to know more about the propulsion block, go to my 2016 mentorship playlist, um, month 4. I go through the PD arrays, the basic PD arrays. I give you an overview of what they are, a simplistic overview. It's not a complete expose of them, but it'll give you more information about what it is. And then market springs through and gets up to the consequent encroachment, making the higher high, which is the consequent encroachment of this old buy side imbalance, sell side efficiency uh, fair value gap. Right, here's the British pound or cable daily chart left-hand side. I mentioned on Friday we traded down to this bullish fair value gap, and the bodies were respecting consequent encroachment. That's the midpoint of that after taking out Friday's low. So we have this wick here. I'm added in here, and it's a little bit lighter in color versus the ones that are up here. So just be mindful of the color change between these and this, and just look at your times and the price. So that way you can see what reference points these levels are in relationship to the daily chart when we're looking over here, because there's a lot of lines over here. So whether we're bullish or bearish, the market will want to go back up into this wick and maybe even trade back up into this area here. So this discount wick. Bullish or bearish, it doesn't matter. I always look for price to try to gravitate back into these. Now, if I'm bullish, I want to see it trade into the upper quadrants. If I'm bearish, I want to see it find resistance in the lower half of these discount wicks. Okay. So over here we have the London kill zone, the breakaway gap again, like on fiber. We have an institutional ortho entry drill, which is this candlestick. We trade one tick below the previous candle and leave the gap open. Then we have a fair value gap there, and it's also occurring right at the consequent encroachment of this bullish fair value gap. See the red line? That price right there is this price. So the market hits that, and we also have a fair value gap and a order block, which is change state delivery. It wicks through it just to tap the fair value gap and the consequent encroachment. There's times when my PD arrays will just allow the market to color outside the lines. When there's a confluence of PD arrays, that's why it's doing that little coloring outside the lines. It's not randomness. It's the fact that it's going to these more significant PD arrays that's in line with what the present narrative is. So if the market's bullish, it's going to really come down here and offer an opportunity. If it's in close proximity, whatever the lowest PD array is in that cluster of price action, it'll reach for that one like it does here with the fair value gap. And the bodies are respecting that bullish fair value gap here and sends it higher. Once more, accumulates around the upper quadrant of that old bullish fair value gap. That's level here. And springs out of that, comes back down in. It's the low of the sell side liquidity pool of September 11th, daily low. That's this low right here. Okay. So it sweeps the liquidity below that low here, once more here, once more here, and look at the bodies respecting it here, and then sends it higher, accumulates around the lower quadrant of this wick right here. This is September 11th. And then the market runs higher, comes back to the lower quadrant, and then this is the high of that September 11th daily discount wick. That's the open of this candlestick, basically. So this wick is below the candlestick, so it's a discount wick, and it's the high of it. That's this level right here, and it trades right up into that. So we're going to see what we see in regards to continuation. Should cable go higher, I just cleaned the chart up, took everything off, and just making mention of this. This is the present sell side imbalance that's trading into. And if we get above this high here, what I want to see is how we trade to, if at all, if we even get to the midpoint of that. If it's bullish, it'll have no problem getting up to the midpoint and go higher. If it's bearish, it may falter and roll over before getting here, or it needs to trade to the upper, not the upper, but the lower quadrant level here, or this level and fail and then roll over. That would be indicative of weakness. So these are like the lines in the sand to determine, because we're in a consolidation with the dollar index and so many wartime events, setting the stage for future, military actions. That's going to have a direct impact on the dollar. So it's kind of like a wait and see, but these are the things I'm watching, and hopefully it's been insightful to you.